I see some green shoots.
We need to have some kind of stupid bar.
I just think this is a classic structure, Lamont.
And I'll show you guys, a little trick here.
When you see some of the stuff that we're working on, you're going to like it.
Welcome, Wyckoff Nation, to the Wyckoff Market Discussion. This is session number 14 of year 2022, episode 293. This is a very special session for us because it's an open door session, so we have a lot of guests and a lot of people who will be watching this video afterwards. So we definitely wanted to go all the way out and create as many slides on many ideas as possible. So today's sessions is going to be very intense. We don't have a lot of time and we have a lot of information that we want to convey. With that, let me quickly go through some of the announcements and then we're going to start discussing the market with Bruce. In the upcoming events, tape reading with William and myself each Monday, conducted by Wyckoff Analytics at 9 a.m. Pacific. This is the class where William and myself just go through the market and use our tape reading techniques to identify where we are in the Wyckoff structure and what could we expect. We also go through some of the exercises where we again showcase some of the tape reading techniques, and it's a very kind of like detailed, a very advanced class. So for those of you who are into the tape reading or chart reading rather, check it out. Wyckoff Crypto Discussion, which comes out each Wednesday on demand with Alessio and myself. And this is the 30-minute update, weekly update on the crypto world. Very fascinating. Alessio is our crypto expert, and the way how he thinks about the crypto world, the crypto assets in the Wyckoff context is very, very unique. And then each Friday on Stock Charts TV, you could find power charting episodes with Bruce on air at 3 p.m. Eastern, and then later on there and our YouTube channel. This class is a promotional class. So if you decide to sign up to Wyckoff Market Discussion classes, $79 instead of $99, only for 1 week until next session, which is going to be on April 13th by 3 p.m. Pacific. Go to our website, wyckoffanalytics.com, sign up, and we will be happy to have you as part of our community. And with that, Bruce, hi, how are you doing today? Are you ready for this class?
I'm as ready as I'm going to be. I'm so grateful for all our guests and for our regular attendees. And hi, everybody. And I'd just like to point out that I just wrote a new blog. You can see the website there, articles/Wyckoff at stockcharts.com. Go check it out. A couple of the charts we're going to talk about are in there where you can pull them up, blow them up, take a closer look at them. And so check it out.
Sounds great. And I would very highly recommend Bruce's blogs, just because it's a book that has been written on stockcharts.com on Wyckoff methodology. So check it out. All right, well, let's start with the markets, and we're going to start with the big perspective on the geopolitical situation that we have right now, on sanctions that are coming to Russia, on Fed decisions for this year, and on what we think could be the new financial order that is being set up as a foundation right now, and what all of this could lead us to. And then after that, we're going to switch to charts, and we're going to make sure that all of those ideas are being portrayed on the charts. We're going to try to find some kind of evidence, whether confirmation or failure of those ideas, and it's going to be a discussion, as it usually is. All right, so let's talk about the war, and we'll try to be as non-emotional as possible. We're going to try to figure out what kind of economic effect the war is having on the world economy. So first of all, as we go through the analysis of the war right now, it seems to us that the war will be somewhat of the prolonged war. If we even gonna have some kind of ceasefire, that's gonna come into end of this month, beginning of May. But the battle for the east and the south of the Ukraine could be, very fierce, very long-term oriented. And what we're hearing from military analysts is that the war could actually go on even longer than, April and May. With this, Russia might be drafting and possibly mobilizing more troops, and that will only prolong the war. U.S. Right now indicates that they want Ukraine to define the direction of this war, meaning that Ukraine's decision is going to also influence the duration of this war. So why is this important? Duration of the war is important because the sanctions are going to be still on Russia for the duration of the war and even after. And that is definitely going to influence the economy. So what are the sanctions on Russia that we so far know? There is kind of like a general theme on the sanctions is that limitations on selling products to Russia, limitations on buying products from Russia, limitations on financial transactions, and only limited payments associated with certain transactions, either for oil and gas that are still happening right now. Debt payments will be left. Foreign businesses are out of Russia, which also produces a huge high unemployment as foreign businesses are coming out. Then, more importantly, embargo on coal, which is already in effect, and more importantly, embargo on oil and gas that is being discussed right now by Europe and the United States. And that, I think, is definitely coming, especially after the latest events. All of this will lead to the closed out Russian economy, and I believe that Russia will go through the default as they did in 1998. This will be different, but it will be very steep, very fast, and that will influence the world economy. In Europe, in the next 2 years, there's going to be limitation first, and then a total substitute of Russian gas and oil. So we have to think about the new logistics for gas and oil purchases and deliveries around the world. So one of the examples of that is that the gas is being delivered to countries like Germany, like Italy, where dependency on Russian gas is enormous, from between 40 to 55%. And it's being delivered by pipelines. The US delivery of gas to Europe is in liquefied form, so by ships. So you have to rethink the whole logistics to put the new delivery routes, to understand how you could get this liquefied gas in on plants, factories in Europe, put it in a different format and then deliver it, to the final consumer. And that's going to take time to build this type of logistics. And then obviously both in Europe and in the US, there's going to be increased military defensive spending. We will talk about sectors, we will talk about specific groups, and we will see how that is being reflected already in some kind of, military spending and defensive contractors are benefiting from this right now. Ukraine, Russia are also number one and number two importers of grains, specifically wheat, and Ukraine is also a big importer of the vegetable oil. That will influence the food prices increases around the world, and this is going to influence the inflation. So inflation on the top of what we're going to do what we're having right now is going to increase even more. On the other side, the Fed is way behind the current yield, which brings them to the point where they're going to be aggressively increasing the Fed rate. In May, we're expecting 50 basis points, and We also heard yesterday that they will be more aggressive in decreasing the balance sheet. So 3 steps and a stumble. And here I definitely would like Bruce to come back to this and comment on this. But as a conclusion, we think that in the next 2 years, there's going to be a major world restructuring of the economy, of the world economy, new ways to get oil and gas to Europe. World will have to go through the severe food crisis, unfolding especially already right now in the low-income countries, worldwide inflation and slow economic growth that potentially could lead us to stagflation. Bruce, let's definitely have your thoughts on this. And just because we have a lot of material ahead of us, this is just a kind of like a quick macro perspective on where we are and what could possibly come. Any thoughts that you have, please go ahead.
Well, thanks, Ramon. And the thing that really we want to emphasize today relative to all of this is that we still think that the investment environment is going to have a lot of fruitful opportunity as we go forward. It's just that we're going to see tremendous rotation of where the action is, where the investment opportunities are. We're going to try to express that today as we go through in the time that we have. The idea of 3 steps and a stumble is that you have 3 steps, 3 action steps of tightening by the Fed, and it creates a stumble in the stock market. And so that was a classic term that was described by Edson Gould, who is just a great technical analyst. And as a matter of fact, recently I'd read all of his old newsletters. I recently came across those and was going through them again. He's absolutely brilliant. And it's not all he created, but 3 steps in a stumble. It's actually become in recent years more like 6 steps in a stumble, where you can have just a series of rate increases or tightening actions that will result in a slowdown in the stock market or a reversal in the upward trend. And so the notion really is that we're in a tightening environment, and we're going to show you how different ways to look at that tightening environment. And as you all know, we're seeing that happening in the 2-year treasuries, in the 10 years. We're seeing it in the yield curve and so on. And we'll have some charts on that in a minute. But the idea is that we're into a tightening environment. We've had 1 step here, and that's a 1/4 point increase in the Fed funds rate. So we've had 1 1/4 point rate increase. That's it. And so until we start to see substantive action in the form of additional rate increases, history tells us that the market still has the potential to go up, or areas of the market have the potential to go up. So I'll leave it at that for now, and we'll circle back to that later.
Yeah, we have so much material, so we're gonna go really fast. Bruce, let's talk about the long-term trend. And here is the chart of the Dow Jones Industrial Average. Where are we in this chart? And at the bottom, there is the momentum indicator. So what do we see from that as well?
So here we're looking at monthly bars on the Dow Jones Industrial Average going back really to the beginning of this epic bull run that we've been at since 2009. This is classic Wyckoff reverse use of trend line analysis, where in this case, the reverse use is, and I always draw the solid line as the primary trend line, and then the dotted is the parallel. And so, but you can see they both have merit on their own accord. But here, the supply line over the market, there's attempts for a few months to get above that supply line, and then the Dow will come back down, retest it. We saw that happen in 2018, and then cascade it down. That December period in 2018 was a pretty severe sharp break in the market all came at once. And then of course we have the COVID decline that was substantially larger than that. And so once you get into the channel, that can be a period where we can get volatility. Now, just pointing out here that the Dow has rallied up to the underside of this overhanging supply line, and it's right there. And to me, this is just a point of vulnerability. Doesn't mean we have to go all the way down to the bottom of the channel, but it does mean that there could be volatility in the market when we get into a situation like that. And then Roman just highlighted that whole structure, which goes back, I mean, literally now we've been in a range bound condition for a year. And you can really see that up there as it threw over the top of the channel, rode across the top of the channel, and now has fallen back into it again. And notice how the start of this really occurred when we got into 2022. As soon as we got into the new year, that's when the selling started to happen, which I think was a large institutional force at work saying, okay, we've gotten it through 2021, we're going to get our bonuses, and then they started to raise cash or rotate out of certain assets. We'll talk more about that. So here you can see in the stochastic below, this is just a terrific indicator of directionality. And notice in 2009, right there at the low, that when you went from an oversold condition in the stochastic and turned up, that it remained persistently up, all the way through the first leg into 2010. Well, we can see in the subsequent areas that once you start to turn up on the stochastic, it's pretty persistently up, or once you get a commitment below the overbought line and it's trending down, persistently down. Well, look where we are now. And so we can see that we've built some kind of a large distributional structure here in this green area of 2021 into 22, and now it's trending down. So we have directionality of the momentum in a downward direction, which coincides with the most recent bar in the Dow. And just in case you're thinking, some of you are thinking, well, you know, the Dow's an archaic old index. Well, the other ones look like this too. And we're going to show you an example of another one later on. But anyway, the Dow, I like the Dow because I think it's a very important psychological index, but the other ones look this way too.
Excellent. All right, let's move on. Let's talk about historical analogs. So I promised you guys to bring quite a few of those. So we're going to look at quite a few of those. So this is the NASDAQ Composite monthly chart, and this is from 1990 low into the top of 2000. And I want to point your attention to the last portion of this secular uptrend that started ironically with the Russian default here in 1998, also long-term capital failure. And then we have a very, very quick speculation on the way up. We have a term in Wyckoff methodology, hypodermic top, hypodermic distribution. Hypodermic distribution is a part of the TP family formation. And for those of you, again, who are not familiar with this, the TP formation shows urgent selling after the speculation on the way down by institutions that could have some short-term pauses in the downtrend. But primarily, the whole idea is just to kind of gradually sell a lot of the assets. And look at the current picture. This is NASDAQ Composite, also monthly chart from 2009 low. And the last portion of it, of the COVID low, as we know, has been very aggressive. There is a lot of momentum. There is a lot of speculation. And now it seems like we have just had the first change of behavior where after which we had an expectation that we're going to have a rally. It just happened. And we might have some kind of hesitation here. But if we break this level of support, we most definitely going to continue to the downside. And then the target for us, as in 2001, 2002, 2003 bottoming formation, would be very, very low. It would be at the base of where the COVID low has happened. So it's a pretty long drive to the downside. Okay, well, let's look at the more optimistic picture, because every time that we go through some kind of analysis, Wyckoff analysis, we teach our students to look at both scenarios. It's very important that the trader obtain a objective view of what is going on. It also very important that Wyckoff trader understanding different type of possible structural scenarios, and also how those could either fail or confirm the unfolding of the price action. So in this case, we're looking at the accumulation analogs, and at the top left, we have S&P 500 current picture. Let's start with 2010, and let's compare this to. So the price action develops kind of like in the same way. First, we have the move to the downside, which is a sign of weakness, which concludes with the local selling climax, stop in action. And then from there to 3, we have a change of behavior of the small downtrend, which suggests a trading range in both cases. Then we seen how the weakness creates a linear regression, which is sloping down, and then from the sprint position at 4 in both cases, we are having a rally. It's very important to understand how the rally in 2010 has developed. First, we have some kind of momentum move, and then secondly, we have reactions and the slowing down of the upward momentum. Now, this ability to slow down the momentum, but still to be in the upper part of the trading range is extremely important bullish characteristics. So if we were here to do something similar, where we would spend some time at the top of the range, we would start perceiving this character as much more bullish. We obviously need to still have some kind of reaction here. This type of picture where we see the sign of weakness, even though this is a sprint event and the test event after that, it's still a lower low. And let's not forget about this. And what precedes this lower low are lower highs. So therefore, again, that weakness that we're seeing in the price structure. So for the bullish last point of support as phase C, as the lowest point for the uptrend, we would be thinking that whatever supply is coming in is not going to be aggressive. Whatever price action to the downside will be, it's not going to be aggressive. And it's very important to create a higher low in this type of the scenario. The same way how it was in 2011. After this sprint, we have a sign of strength or a change of behavior, a rally. And then we have a very substantial decline into 1/2 of the trading range, which is turned out to be a last point of support. And the way for us to confirm that, let's say it's going to be a reaccumulation in the current scenario, is the way how price recovers out of this low, and the way how the price breaks out of this low. That is one of the most important things for us to observe. In 1990, this is an Iraq war. This is where oil was going up significantly. We have somewhat of the same structure. Again, sign of weakness, automatic rally after the selling climax. The linear regression channel is pointing down, and then we have a change of behavior that is not necessarily as strong as we have had just recently. It has certain reactions where supply is still present, but they all end with some kind of higher low. That's what we're looking for. And they all recover in the same way, very aggressive buying to the upside. And this is what, Bruce, we probably would be looking in the accumulation or rather reaccumulation type of scenario. Your quick thoughts on this? Bruce, you are muted.
So sorry. So at point 4, you can see that the essential attribute in the chart is something that we call in Wyckoff absorption. And so there's this slowing of momentum in the decline, which shows that there is accumulation or absorption taking place on the way down. And then point 5 shows that there's really good demand and an exhaustion of supply that occurred at 4. And so that next pullback to a higher low kind of completes the set. And I always look for that sign of strength and then look for a last point of support to follow that. And so this is so far this is a classic look. And that would be and then the only other thing I could really add to this is that, you know, the Fed really has been, you know, very timid in their actions. They have not tightened significantly, even though the markets have tightened. And so that in and of itself could create somewhat of a positive backdrop for the market to attempt another good rally and potentially go to new highs.
All right, let's look at the distributional analogs, and we're going to do this the same way. So a sign of weakness, and in 2000, NASDAQ 2000, we looked at this chart many times. Sign of weakness, and then a rally into the automatic rally high, a change of behavior for the short-term downtrend, a sprint at 4, a rally into 5, and that's why this calling of this rally was so spot on. You know, we were actually expecting it for quite some time at sprint, after this sprint, and then look at how in 2000 the breakdown area cannot be overcome, and this is probably the most important element of the distributional analog. Could we rally in such way that we would overcome the initial breakdown area? Look at 2007, also NASDAQ. The breakdown cannot be overcome, and that limits the result to the upside, and that is still suggestive of lower prices. ARC 2021, the same thing. Look how we are trying to rally, and we're having a really great rally out of the spring event, and yet we're failing again and again and again, and now we are in the downtrend. So Bruce, we've looked now at both accumulation and distribution analogs. Is there any appeal for you personally to one scenario over another?
Well, you know, obviously I'm an eternal bull, and so my preference is to see prices go higher, but I'm also an opportunist, so I'm going to take advantage of these swing trading lows and highs and try to trade accordingly, with the notion, Ramon, that we are in a big range-bound condition here and have been for quite a while now. And so I'm continuing to focus on this as a range-bound situation. We're really addressing that here in the Wyckoff market discussions on being opportunistic on these swing trading opportunities. And I think the one that we just had, which we're going to talk more about in a few minutes, addresses that. But my preference obviously would be to see this market put in a good last point of support and then attempt to go to another new high. And so that's kind of the way I'm leaning. And I think there's reason to believe that can happen, not only technically, but also from a you know, a monetary backdrop and an economic backdrop.
All right. Let's move on. Let's look at another analog. So this is NASDAQ 2000, 2003, the top. And then we are looking at ARC, and this is probably something, guys, that you have seen many times. So we're going to go really quickly through this. ARC resembles the similarities in the price structure of NASDAQ top in 2000. So again, a sign of weakness, a spring event at point number 3, attempts to go up at 4 and 5, and again, inability to overcome and commit above the breakdown level, this sell-in zone. And this is going to be very crucial for us in determination what the current trading range is all about. Is it a reaccumulation or is it a distributional range? And then when we look, and by the way, one more point here. Look at how in 2002, 2000, or 2001, 2002, the lows in NASDAQ were the price reached the lows of the 1999 low. So that's a very substantial decline. All of this speculation that was present in the market at that time was negated by this downtrend. So I think, Bruce, that we could potentially say that ARC is still in the downtrend. I don't see any big changes of behavior in price action. I don't see any changes of behavior on the relative basis as well. So we probably could assume that the target could be that COVID low, and ARC still has some rotational distribution underway and still in the downtrend.
You know, there's another analog here that's at work that is not expressly stated in these charts, and that is that 2000 to 2003, there was a tremendous rotation, and it was away from these growth stocks. And this is something I'm really speaking to the speculators that are in our group and those of you that are visiting, that this is really important, because there's always a tendency to keep speculating in the areas that were working before. This happened in 2000 into the 2000 peak, and there was tremendous opportunity if you were aware of the rotational emphasis, and you had to get away from these NASDAQ growth stocks back then and rotate into what was starting to work. And there were very deliberate themes that were at work back then that were, and one of them was energy. Energy was starting to come into favor, and what happened, I think, is that the stocks that were these growth stocks of that era were a source of funds that came out of those stocks as they went down and went into these other areas that had deeper value, had maybe some yield characteristics, but also were starting to show relative outperformance. And it was really important to stay focused on that rotational, keep our eye on the ball, using a baseball metaphor for the start of baseball season, because this is clearly, I believe, what we're seeing in ARC. And nothing against ARC. We're going to show you some more charts there, but it is a classic relationship to what happened back then. And these stocks that were, the massive growth names of this era, different from the growth names of back in 2000 to 03, but these stocks are becoming a source of funds to go into other areas, materials, energy, maybe industrial, healthcare, and so on. So we're going to really focus a lot on that as we go forward.
All right, well, let's continue with this idea. So NASDAQ in 2000, 2003, could the current picture have some kind of similarities? Well, at least on the price action level, we definitely see the same type of structure being developed. At 1, the top; at 2, sign of weakness; 3, a local spring that brings us to the best rally in the trading range, and then after that, failure and failure. So we are thinking that we're somewhere here. And this is very crucial, because whatever is going to happen in the next months or so is probably gonna dictate what we're gonna have. Are we gonna have a final break below the low and continuation to the downside, or are we actually gonna stop here as the higher low and then decisively will go up and that will become a reaccumulation? So it's going to be very interesting, Bruce, to observe all of this in the next months or so, and just to see where we're going to end up. All
You
right.
know, let me just make a point on that chart very fast. That point one on the top chart, NASDAQ went over 5,000 on that index. And by the time the low was put in, it had gone below 1,200. And I'm not saying that's going to happen this time. We can't know, but we are not, we all have to commit that we're not going to get caught in a loss trap in these prior leadership names. If they start, we have to set a point where it's literally like a mega stop point where we just say, you know, we're out of this. There's no way I'm going to take down an index from the equivalent of 5,000 to down under 1,200. And that was a remarkable decline, remarkable destruction in a lot of stocks, many of which went away. They just went away. And so we don't know that that could happen here, but history tells us it can happen. And so just be really, really defensive and be a good risk manager as we go forward in time, and really keep these analogs in mind. I have analog envy because Roman is so good at these. And so here's the next chart, which I have. This is my attempt. This is what I call my analog envy chart because Roman does such a good job on these. So anyway, I showed this to Roman for the first time today. I've been working on it for a while. And basically what you're looking at in the top chart is the Spanish flu pandemic, 1917 to, and now what we're looking at is to the 1919 peak in the market, and the actual first case that was recorded. We don't know where it started and what the origins were back then, but the first case that was recorded was actually in Kansas in March of 1918. And so we're, you know, most likely it was already at work in, you know, somewhere before that low was put in. And so what I did is I went back and just lined up the time frames are, the calendar time frames are the same. The dates are obviously different because back then that was December, mid-December of 2017, the low in the Dow, and then on the bottom chart, the low is obviously the COVID low of March of 2020. And so and you can see here that there's a somewhat of a family resemblance, both in terms of the amount of time spent going up and also the way that the markets went up, a little bit of difference. So they're not perfect analogs, but you can see that 685 days trough to peak in 17 to 20. And then if you look at the Dow or the NDX, you look at the second peak there, that's the NASDAQ 100, 645 days. And so, Roman, what do you think?
Well, first of all, I love these analogs, Bruce. I mean, like these are my two favorite charts, you know, for this session. What happened in 1920? So we had a significant decline, and I'm not sure that I remember the history from 1920 off the top of my head, but we came back.
Unfortunately, I do remember the history from
Okay.
1920, but I'm
Did
not
we
going
stop
to
here?
divulge whether I was around then or not.
Yeah, I'm not going to ask that question. But did we stop here?
Well, you know, you've been really talking about this from a different perspective, really since we started this episode, and that is that the actual decline went below the lows of 1917. So the decline retraced everything that was gained from 17 to 20 and then went back down and took that low out at the final low. So that's the next part of the analog that we need to keep in mind. But the other thing you can see here is you can see the peaks. There are commonalities in the peaks that are almost like identical. So you can see in 1918 in May that there's a spike up there. And in August of 2020, you can see a spike up. And then there's another spike up in October of 1918. And there's also a spike up in March of 2021. And so you can, yes, you can see those. And then there's one final run upward that has sort of a climactic quality in two phases from that point on. And we had that in 1919, and then also we had that in 2021. So you can see that there's really some similarities in the way those markets advanced. Distribution form, classic Wyckoff distribution there in late 2019. Last point of supply, breakdown into a sign of weakness, and then another last point of supply rally. And we've got the same kind of a look going on here. So that's really just fascinating. We're just going to have to keep an eye on that.
I think, Bruce, this is very scary, just to think that, it's so analogous. And that's why, guys, we are saying to you that the next reaction is going to be the key. How would it go down?
Yes.
Is there going to be a lot of momentum to the downside? Is there going to be a lot of verticality to the downside? Is it going to break the support? Is it going to create the new lower low? All of those things are extremely important for the long-term picture.
And that's where your point about the last point of support coming after a sign of strength on those prior charts is so important. This decline, the first part of the decline, usually in a sign of or in a reaction into a last point of support. Now, these are obviously Wyckoff terms. We talk a lot about them here, but the first part is usually the most volatile, and it's pretty volatile right now, this decline. And then it starts to slow its descent pretty quickly in a last point of support decline. Here you can see that it starts to sell off, and the selling is just persistent all the way through. And so we should start to be able to see those distinctions very, very soon in the way this market goes down.
All right. Well, Bruce, probably just kind of like a small repeat here.
So yes, and then the only difference here is keep in mind that the Dow back in 1917 to 20 was maybe a bit more of a speculative index. Back in those days, it's a little bit maybe more blue chip now, and that so it has somewhat, I would say, more characteristic of the NASDAQ 100 then to now. But here is the Dow to the Dow then and now, and look at the Dow actually held up much longer to its peak where the red arrow is 652 days trough to peak to 685. So very close to the same amount of time. Also note at the distributional structure, we talked about how there is one in the Dow then 1920, but look at the size of the potential distributional structure that we're seeing now across this area. So that's very interesting too. And that's the reason I think we really need to see this make a higher low and start to rally so that it can negate the potential for this being distribution in the next few months.
All right, let's move on, Bruce. We're at 345. Okay, let's talk about Wyckoff labeling of the current market structure. So here is the S&P, NASDAQ, Russell, and the Dow. And the way how we are interpreting the Wyckoff labeling is that we have a distributional top that produces a change of behavior into a major sign of weakness with the stop in action, which is local stop in action on the increased presence of the demand. And that produces a rally that is a change of behavior rally for this reaction down. This change of behavior is suggestive of the trading range. Our first definition of the bias in the trading range after the change of behavior to the downside is still going to be redistribution to be confirmed or to fail. And we said that in this redistributional trading range, what we are going to see, we're going to see failures. Failures of what? Failures to overcome the breakdown or the selling zone. So far, just because S&P was a little bit stronger, we had a local upthrust, but look how quickly we are failing down and with what kind of ease of movement we're moving down. This is not the end of the day data. The volume signature today has increased, so there is most definitely supply there. And we also had the demand tail. So demand was also present right here in this area. So I would say that not necessarily the best character to fall off the top in a such way, in a such manner where supply is increasing and also we're seeing some kind of ease of movement in price. I also want to point your attention to Russell. So we've talked a lot about the two parts to the trading range, which had reaccumulation characteristics. Out of the apex, we are breaking out, and then we are falling down. Now, there's a lot of arguments and discussions with me from, let's say, like social media that, well, what if this whole thing is the distribution? Why are you not thinking that this is a distribution? I don't see distributional signs here. What I see is the distribution on the way down. It's a very Wyckoffian term, and it's not necessarily, you know, a conventional technical analysis. We are seeing the increase of the supply as the price goes down. So they are selling on the way down. That produces a change of behavior that goes into a short redistributional range. 2018 is a really good analog. The end of 2018 is a really good analog for this decline in Russell. And then we have, again, increase of the supply and very substantial break of the whole structure to the downside, which we label a major sign of weakness. But then as traders, we recognize that there's gonna be a stop in action. There's gonna be a rally. There's gonna be a rally that's gonna be the best rally in the trading range. And this is what we were trading in the last month. And now, where are we with that? The upthrust takes us to the breakdown point and then fails instantly. And Russell is obviously now out of the strong position, goes into the weak position. And again, look at the verticality down, look at the ease of movement with which the price moves. And again, today the volume has increased and supply has increased. And we're already in the middle of the range, weakness. And so far, nothing else. And this weakness comes after the distribution on the way down, after the redistribution, after the extension of the price to the downside as a major sign of weakness, after the inability to overcome this breakdown point, and after the upthrust that fails. So far, I do not see any, I see a change of behavior rally, but I do not see any confirmation that this change of behavior is sustainable until we create a higher low, until we consolidate more here without any follow through to the downside. The bias and the tendency of the price action is still of weakness and still to the downside. Bruce, your thoughts?
Well, the decline in we have the selling climax in the S&P top left, and then we have a lower low with a very large tail that goes down, cannot close below the low of that selling climax, and then rallies up into another lower high. But this was that's I think February 24th.
24th,
Anyway,
yes.
yeah, that low was a very extreme psychological low. We'll show you why in a little bit here. But from that point on, each of the lows that was created after that produced what we call green shoots, and that is internal changes in the structure of the market where we're starting to see improvements in breadth, the AD line. We're seeing improvements in the bullish percent numbers and so on that tell us that there is, at least on a local basis, accumulation going on. And that accumulation, and that really helped us. And we documented all that here, talked about it, because that combination of extreme bearish sentiment and then the subsequent two tests helped give us those green shoots that told us that we were going to get a good outsized rally, probably with short covering, that was going to be able to propel the market up. We got a heck of a rally out of that. It was probably, the best rally of the year, and we were able to really catch pretty much that whole thing. And the only the only thing I'd like to add over here is that preliminary supply point back in September. And we started to see real problems and that big reaction on volume off of that preliminary supply point. And notice the sharp advance after the preliminary supply low down to the bottom of the trend channel. That was the attributes of a climactic rally. And so that really did set off the distributional characteristics that we've seen since. But we pointed out that preliminary supply was likely to be overhanging resistance going forward. And notice how these three advances attempt to get above that resistance area. And the reason that that happened, the reason that we can put resistance to that preliminary supply is because this is where the composite operators, the large informed interest, the really big institutional, the really super smart ones, this is where they were starting to sell stock. This is the point at which we can see that their presence, the footprints of those very large interests, and it shows up in the supply that came in after that peak. So they are going to be using that area as an area for distribution all through there. And that's, notice how we had an upthrust on this most recent rally in March, and immediately it failed back below the high of that preliminary supply level. So this is, and people are calling this head and shoulders type structure. But I mean, there's so much nuance if we just go in, which is classic Wyckoffian, and look at the bars, look at the volume, look at the relative characteristics of rallies and reactions during the structure. There's so much richness of information to us that is available in these chart structures. And I'll leave it at that.
All right, let's move on. Bruce was talking about how we were expecting the rally, especially after the spring, especially after the test. It came, and then we've talked about on different analogs how it will end. It will end in some kind of climactic action, and then the reversal, and then the stronger indices, it would be the reversal of the upthrust top. So Bruce, this is an example of the intraday Wyckoff labeling. So maybe main points here as we are at 353.
Sure, I'll go real fast. These two charts are in this most recent blog that I wrote. So please go refer to that, look at my notes in there, and for a little more detail. But you can see the labeling is somewhat different in the way that you would maybe, this is a fractal relationship. And I called the blog Principles Within Principles, because we're looking at the principles of accumulation or possible redistribution inside of a larger structure. So we can see the selling climax in January, automatic rally, sets the outer range support and resistance, and look at how beautiful that is. Then on this spring of the selling climax in late February, February 24th, we get a immediately return back into the trading range, attempt to test it that occurs, and then we have two tests, each higher lows. That's where all the green shoots showed up, is on those three lows in there, where it said, hey, this internal market characteristics improving all the way through here. And I think that's an argument for the potential for even higher prices later on, Roman, that this might be a big accumulation of sorts. But look at the rally. The rally off that second test in March goes up, 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 and right at the end, and we pointed that out here in the last session, is that it had a climactic surge with a gap that occurred into an upthrust, classic Wyckoff characteristics, threw over the two prior peaks and immediately failed, which is what you expect in a range-bound market. Even if this market is making accumulation, it still it means it has more work to do in a range-bound structure, and that's why I call it unfinished business. And so we still have the potential here for some kind of a good low being made at a higher level in this range-bound structure. So I'll leave it at that for now. Ramon, you can certainly, you may have things you want to add. I want to point out on this chart on the right, this point and figure horizontal counting method, the upward stride. Notice how the upward stride, the yellow trend lines, look at what happened when that finally did break. I mean, look at the severe decline off of the break out of that channel, but also there's a beautiful distribution count, and it touched that 4125 box, the minimum count objective in that range, 4125 to 4050, perfectly at that low. And then I took two segmented counts in that area, which you can go look at on the blog. And we went exactly to the 4625. I didn't bring this up to date because I wanted you to see the original work that was done. Went right exactly to the minimum count objective of segment 1. But look, there is a second larger segment, and if we can get a higher low in here or some kind of a shallow backing up type action here off of this recent upthrust, then we have counts that go to minor new highs. And so there still is the potential in the point and figure structure for a higher count. So just keep that in mind. Doesn't have to get there, but there is potential fuel in the tank for a run up to a new high.
All right, let's move on, Bruce, because 3:57 already, and we still have like 30 plus slides to go through. Let's talk about yields and rates. So this is a very interesting work by Bruce that has been profiled in the previous WMD classes. This is the CPI, and what's kind of like so revolutionary about this is that Bruce is taking the PNF horizontal count on the CPI that shows us that we could have the potentiality for a double-digit inflation, which is not that far away. We're already close to 8%, I believe, on CPI. So Bruce, again, main points here, and then we'll go into the inversion of the yield.
This is a count that goes back in two segments, 2009 then to 2000. And you can see the central tendency in here is 2%. That was what the Fed stated their inflation target was, which 2% is a bit of a disaster for savers and investors, especially in an interest rate world that's bounded by zero. So 2% is difficult to cope with for the investment community. But now here we are tipping 8%. Well, what I've done is I've created a structure for this work. I could count it on a horizontal basis. It's created a bit of a stir among certain people out there. And so the first segment goes 8.25 up to 11.88 CPI. Now, you know, it's anybody's guess. They changed the rules for how they do CPI. So, you know, maybe we're getting close to it. Maybe that's going to start to slow. I actually think that we're going to have a range bound condition now that we've gotten so close to the 8.25 minimum count objective. I think we could even maybe see a bit of a reaction back down into maybe even the sixes, you know, this could take months and months and months. But you know, I think if there is a CPI reversion here back down by a little bit, that the Fed will declare victory, and which would be the worst thing they could do, because look at the bigger count. Bigger count goes up to 15 and 3/4, up to 19 and 3/8. And if that was to happen, we're already at disaster levels for consumers and for investors. 7.9 is a bit of a disaster. And so we'll talk more about this as we go, but I just wanted to show you this because it really it also, I think, supports Ramon's argument about how food price inflation and energy inflation could keep pushing higher.
They are going to keep pushing higher. That will decrease the consumer spending just because a lot of consumers will be outpriced. We're already seeing this in the US in the real estate market. So their mortgage applications for 2 months have been going down, not significantly, but still it's a significant 2 months behind the background where mortgage applications were only increasing in number.
Yeah.
And with that lower consumer spending, lower revenue for the companies, which could potentially bring us to, you know, worse conditions.
Somebody told me today that mortgage rates are over 5 now. So
that's unbelievable with the rate of acceleration of mortgage rates, Bruce. It's almost like within 6-9 months we're seeing, you know, such a rapid acceleration. A lot of buyers are outpriced. All right, so here is a commodity index and a 10-year yield. Bruce, very interesting chart. So again, main points here, we're at 4 o'clock.
Yeah, keep in mind this is quarterly. These are quarterly bars, quarterly data. And so I need to update them because it's through March 29th. So I got to get the end of the first quarter in there. But I just really makes a point because I want to go back and look at the 60s. And you can see their late 60s that interest rates were starting to rise. These are 10-year yields. And so 71 onward is when you started to get the big kickoff in CRB prices as a proxy for inflation starting to infiltrate the real economy. And so notice how 10-year yields started to really go with CRB throughout that period. And here you can see we're in the big disinflationary spiral. And I started in the business of right around the peak of that 10-year treasury yields. At that time, people thought I was nuts to get into the financial industry at that time because it was just an absolute train wreck. But notice the secular decline that occurred into the end of 2021. And now CRB started to take off really aggressively at the COVID low. And you can see that interest rates really weren't responding much. 10-year yields were not responding much to that, where they responded ahead of time to the CRB beginning its advance back in the late 60s into the 70s and 80s. So I think this tells you what's got to happen to interest rates, especially in consideration of that CPI chart that we just looked at. So we're in a new kind of a secular environment for interest rates going forward, I do believe.
All right, let's move on. A lot of talk about the inversion, and obviously inversion is in the last, 20 years or 40 years, has been a very good signal for the recession to come. Please note that inversion itself is not the signal itself, it's the inversion, staying at that level for a certain period of time. That's what gives the signal. And Bruce, maybe a little bit more of the detailed explanation here, but again, just probably main points.
Yeah, so the bottom two panels on this chart's 10-year yields and 2-year yields. This is what they call a 210 yield curve. And but you can do the yield curve on anything. You could do it on 5s, 10s, you could do it on 2s, 30s, anywhere you want. And the key is that when the yield curve is real steep, long end yields are much, much higher than the short end. That's a steep yield curve, and that actually is an indication of an accommodative interest rate environment. When the yield curve flattens, that means that you're getting a lot of demand for short-term interest rates and diminishing demand for long-term. And so the rate at which the 2-year yield is going up now is much faster than the rate at which the 10-year is going up. And you can see that in those two lower panels there. And that is what causes the flattening and then ultimately the potential for inversion. We looked at the history of inversions here in the last week, but we don't have time today. You can see that there was a minor dip to negative in the 210s here a few days ago. And so we're right at a zero bounded yield curve. Now, what we learned from looking at history is that the yield curve, and this is one of the reasons I'm a little reluctant to get super bearish on the market here, is that the yield curve typically lives in the negative yield curve relationship for as much as a year to a year and a half. Negative yield curve before it produces a bear market in stocks and a recession. And so we're just now at the zero bound for the yield curve. And we're going to keep watching this very, very closely. And I'll just point out that the last time we hit a flat yield curve was in 2019. And there was all this consternation about, oh my gosh, the yield curve is flat. We're going to have a recession. And we know it takes a long time, typically, for the yield curve to cook in this negative environment to really drag down the economy. The economy is still pretty strong here. I mean, it's not getting weaker, and maybe it's like bifurcating some, but still, it's it's reasonably good here. And but look what was happening to yields back then. They were dropping. You can see the 10-year dropping and the 2-year dropping. It's just that the 10-year was dropping effectively faster than the 2-year, and that is what caused. Now that's accommodative environment. So we need to look at what yields are doing, and so then they were dropping. Now they're rising, and they're rising fast, and that eventually is going to slow the economy down. There's no doubt about it. But we may be a little early.
All right, let's move on. Okay, this is a 10-year compared to the banks group. And Bruce, this is kind of like a very interesting chart just because when the yields go up, obviously, there's a lot of money to be made in the banking, and yet we're seeing lower highs and lower lows. And the volume is suggestive of selling. The relative strength is showing weakness as well. What is your take on the banks?
Well, the yield curve typically is, when the yield curve flattens for banks, it tends to make it harder for banks to lend and make money because they borrow short, they lend long, and so typically, and so a flatter negative yield curve diminishes their margins. And so here you can see an upthrusting action in January where the market upthrusted, and then you have a decline back down to support late January, and then a rally to a lower high. And then so we could call these a series of last points of supply. And to me, the banks, especially on the relative strength basis down here on the bottom, are starting to turn down on a relative strength and price basis. So I think that the interest rate environment is not conducive to banks
Mm-hmm.
and invest. And I think institutions are looking at it that way.
All right, let's move on. Let's look at the sectors and then let's look at some of the selected groups. So here are all of the 11 sectors. I put some arrows here on the relative strengths just for us to see what's outperforming and what's underperforming. And Bruce, in our discussion, you were mentioning discretionary. So why discretionary is catching your eye?
Well, what we can see here in discretionary is that these are the areas that people can cut back. They don't have to. I mean, a lot of discretionary purchases can be put off, or they can be, eliminated from a budget. And with fuel prices, food prices, and things going up so much, discretionary would be going to a restaurant instead of going to a grocery store, and so on. And so you can see here that there was an attempt in March for the relative strength to rally as it went up to that resistance area of the February high in price. And then now it's turning back down, and the relative strength has turned back down, and it's back below its moving average. So I would just be extremely cautious about discretionary. But then when you go over here and you look at staples, look at the staples, which is the second row, third from the left, and notice how, look at the rally off the March low in the staples. It's rallied all the way back up to the January peak. And now, and look at the relative strength turning straight up. It's in a northward direction. Relative strength, directionality is really, really helpful. We may hit a little bit of resistance on the staples, but I think that this is one of the rotational opportunities in the market right now, is to be thinking more about the staples stocks and sector than, say, the discretionary. And the other area is look at technology and industrials, top right. And you can see there, look at the relative strength, look at the rally up to prior resistance, and then it turns down even ahead of the market, the technology index, and is heading south again. And the industrials went up. They were acting pretty well there for a while, but look what happened in the last run up in the industrials. Notice how the relative strength turned down and was starting to go southward from early March onward. As the industrials were going up, they were losing their relative performance throughout. And that was a huge warning, because look at the reaction that occurred in the industrials, which has been larger and steeper and stronger, the weakness, than the other sectors. So those really stand out to me, Ramon. What are you seeing?
Well, two main points, and just because we have to move on. First of all, look at the defensive sectors, right? So for instance, utilities, look at this rally. It actually overcame the high of late December, January high, and it just so aggressive. So you could see the aggressiveness by institutions to be present in this sector. And that you could observe also, Bruce mentioned staples, look at the healthcare, look at the real estate, and also look at the aggressiveness with which, and Bruce mentioned this as well, with which the reversals are happening in other sectors that are under pressure. And I think it's very telling story of what is going on. It's not just the rotation, but there is an aggression about the way, with the speed with which this rotation happens. And I think it's
And
very telling.
and let me just add on to your point, because this, I think, is going to be the really important part of being successful as a speculator or investor going forward, is doing the rotational analysis and understanding where strength is coming in and where it's waning. And you can really see that in the bars. You can see that in the Wyckoff analysis. And I think that we can pretty much stay on the right side of these themes and also avoid the volatility and the trouble that could come in the overpriced segments of the market. And I'd also just like to make a point here before we move on is the communication services XLC top left. And you can see there that there's like a little bit of a green shoot in the relative strength where it's trying to turn up series of higher lows there in March, and it's trying to reassert after look at the long-term weakness in the relative strength that accompanies the downward trend in price. And so if we can get that turning up, this could be a nascent sign that rotation is about to turn back into the communication stocks. Just a thought.
All right. Let's move on. Now let's look at selected groups. I mean, the question is, where is strength? Where the money is going to? The money never sleeps. The money, even the cash, is a position. So we want to understand if the money is coming out of certain sectors, certain groups, where is the money going? Well, obviously defense group, just because of the war in Ukraine. That produces a big spike in institutional demand for these shares, for these companies, and look how dynamically the price goes up. And it looks like climactic action, right? And indeed, on the intermediate basis, it is a small climax right here. It is a small change of behavior, but look how the price is holding here and how supply and selling is diminishing. Relative strength is accelerating. I love to see relative strength deviating a lot from its moving average, and this is exactly what we're seeing. This usually shows me some kind of urgency by institutions to be in this theme. The same for coil, obviously with the sanctions, this is going to be a little bit in demand. And look again how we're deviating from the moving average, how we're so flat in this reaction after what seems to be a sign of strength after a potential reaccumulation formation. Same for oil equipment and services, and this is not necessarily, or this is the only group in the energy that is of interest to us. You can look at other oil-related themes, and they're also going to have very, very favorable relative strength, uptrend, acceleration to the upside, price uptrend as well, and not a very meaningful reaction. And metals. Metals, I would say, is probably, as a group, the weakest. And if you look at certain metals, you will definitely see some strength there. And if you look at others, you will see some most recent selling, which is very interesting and somewhat surprising. We'll talk about silver and gold in a second, but I would say that the metals is probably the weakest out of all of these groups.
And let me just point out that in each of these cases, look at the beautiful structures of reaccumulation that have occurred prior to the jump up and out. So, I mean, reaccumulation is one of my absolute favorite Wyckoff structures, and you can really see that a huge cause was built, in some cases going back a year, in setting up the conditions for these advances.
All right, let's move on. Bruce, we're at 418. Let's look at the transportation logistics. First of all, a comparison between the Dow Jones Industrial and the Dow Jones Transportation, a very old technique for us to see where the market is heading. And Bruce, this is definitely looking somewhat ominous. Not only we are coming back into the formation, into the structure, after an attempt to locally upthrust the price here, but the way how we move down, the character with which we move down, is just mind-boggling. It's just so fast. There is a lot of aggression to sell, and again, a lot of logistics are collapsing right now around the world, as there is some economic restructuring, economic rotation that is happening for the suppliers of materials around the world. And this is very, very telling, Bruce. So very quickly, a couple of thoughts on the Dow Jones and the transportation as the indication of the potential bias.
Charles Dow basically set up this thing called the Dow theory, and it was really brilliant. It's one of the real early technical analysis techniques or methods, and has gotten a lot of attention through the years. And it basically employs the Dow Jones Industrial Average and the Dow Jones Transportations as a confirmation, non-confirmation set of indicators, with the idea that the transports are the index, that transportations are the things that drive the real economy. Things move on transportation, on rails, trucks, etc. And so the things that are built by the industrials have to be shipped by the transportation. I think this is such an interesting structure because you need to get a high, a lower high, a lower low, or a low. So let's call that the January low, and then a lower high and a lower low. So I think that February 24th low is a signal, a bear signal in the industrials. So then the question is the transports, did they confirm? That's how you get a Dow theory sell. So we had a high in November, and then you have let's call it the late November, early December low, an initial low. Then you have a lower high into January, and then a lower low either in January or February. And so now, did we in fact get a confirmation of a Dow theory sell signal at the February low? And so I think it's possible, and it would really be confirmed if we had the transports go down and make another lower low below the February lows. So something really interesting that we may want to keep in mind.
I wonder, with this type of the velocity and aggression, if we're gonna see another lower low here in the transport routes pretty quickly.
Yeah, and that would.
Let's look at the. I'm sorry. Say again.
Go ahead. Go ahead.
Let's look at some of the groups that relates to transportation. So railroads. Look at how quickly we're going down. Trucking. Look at how quickly and aggressively we're going down. Look at the volume signature here, which indicates selling, right? So we're not going anywhere here. We are going lower and lower each time. This is an element of the sign of weakness. Then we are producing a major sign of weakness. With that, the bias changes to the downside now. And we are coming into this formation with an idea of the redistribution to be confirmed or to fail. And how are we failing here? Off the selling zone, off the upthrust action. This is so decisive here in trucking. It's probably the most dramatic chart for today that we could see, Bruce. I mean, like, this is just like, get me out of this as soon as possible. Delivery services, the same. Last point of supply after a major change of behavior, after an attempt to rally, multiple attempts to overcome the previous high and failures on all of them, minor sign of weakness in the structure. And the last rally is just like the worst rally in this whole trading range. And then again, aggression on the increased supply signature. Bruce, what are your quick thoughts on this?
I believe that you can use price charts to be able to tell what the economy's doing. You can use price charts of stocks and industry groups and indexes to tell what's going on in individual themes. I mean, I'm really like a pure technician. I know you are too, Ramon. And to see this drop in the trucking, this just says that the economy is slowing rapidly. And to me, this says that there are at least segments of the economy that are slowing. Others might be heating up, but this would be the thing that would argue to me that the discretionary sector is in trouble because things are just not being shipped. And so Certain things are being shipped, a lot of things aren't. Delivery services, look at that redistribution there. That is a classic redistribution that occurred. You have in February, you have an upthrusting action, and not only in trucking, but look at the delivery services below that, Ramon. And so a big gap and an upthrust, and then a failure into a sign of weakness, last point of supply. I mean, that's a big point and figure count back to October of last year in delivery services. And so I think this says that there are segments of the economy, because of high energy prices and high food prices, that are slowing rapidly, you know, and also in the airlines. So that's two big redistributions in the airlines going down.
Yeah. Pretty interesting picture here, and especially in the last week, as you guys are commenting here in your comments. Yeah, the last week has just shown us, that type of acceleration. So obviously, again, aggression with the Fed rates hikes that could lead to lower consumer spending, that could lead to fewer deliveries, and so on and so forth. It's all interrelated. And obviously, a lot of logistics are being broken because of the war. Even what's going on in China right now. And I mean, we are not even bringing this up, but they're going through their own lockdowns, and it's just kind of interesting how that occurs right now when the whole world, it seems to be like, to be in a better shape about this. All right, let's talk about the market breadth, Bruce. So we usually use 200 moving average, stocks above 200 moving averages, and also above the 50 moving average. And we usually start with the takeoff momentum in breadth, which occurred in 2009 and off the COVID low. They are very similar looking. After that, we don't have to have necessarily a very, another higher low, higher high. We could have lower highs and still we could be trending. We have shown you multiple times that this happens with this indicator. But within the structure of the uptrend, we are going to have some kind of declines that are going to be having their own patterns of how they unfold. So usually we'll have some kind of sign of weakness, then a more meaningful decline in breadth. Well, so far, Bruce, I think that we have that sign of weakness, at least, where we go to 30% of all stocks above the 200. We're trying to rally, but this is still kind of, to me, still to the downside. We need to overcome this moving average right here, and just to show that we could potentially rally. But so far, I don't see that.
Yeah, you can a little bit see the green shoots in the first quarter in this indicator. Look at the low and then the higher lows that followed, which shows that the number of stocks that are living under their 200-day moving average is diminishing. It's shrinking. And that, as the market was attempting to push lower, was really a positive sign for an early advance in the market, and we got it. And so if we can make another pullback here into another higher low in price and in the indicator, I will continue to be bullish. And I'm just going to go with what the market tells me to do here. And we've looked at endless examples of this indicator making a series of positive divergences and really signaling good rallies. I'm looking at a few of them right here that we don't have time to get into today, but we'll do more of it in the future. But I still contend that there are green shoots inside of this indicator, Ramon.
All right, let's look at the stocks above 50 moving average.
There it is. You can really see it there.
Yeah. Bruce, please.
Oh, just what Ramon drew there. Look at the higher lows since December in the stocks above their 50. So these are the stocks in the New York Stock Exchange. We also look at the NASDAQ comp. These are the stocks that are above their 50-day moving average. And as long as that indicator just keeps making higher lows as the index, and here the S&P, look at the lower lows, January, February, March, and higher lows, higher lows, higher lows throughout that whole period. And there's endless examples of this going on. And it produces good local rallies. And in some cases, really good kickoff rallies. Look at September, October of last year. Lower lows in the S&P 500 into the beginning of October, higher lows in this indicator, and a really good rally followed. So let's just follow what the internals and what the market characteristics of price are showing us, and just keep trading these markets opportunistically up and down.
Bruce, I have only one question here as we're talking about the divergence of higher lows and lower lows. What about higher highs and lower highs?
Well, I think that now it's a case where we need to see the ability of this indicator to be able to pull back reluctantly down maybe into the 40% range, and be able to show the ability to be able to keep a lot of these stocks above their 50-day moving average. And with that last point of support scenario that you laid out for us earlier, Roman. And so I think that's going to be the key. Is I actually think that the fact that this got up to near 70% is actually constructive on the 50-day. And we'll start, the 50 days got to turn up before the 200-day can. And so you can get in the majority of stocks, over 50% of stocks above their 200-day moving average. Now you've got a good foundation for some kind of a more important rally to occur.
I think if we would see at least some positive news where parts of the inflation associated with the war are going to slow down, right? So this means ceasefire,
Yes.
peace agreement, lifting of some of the sanctions, which I don't expect that's going to happen this year at all, or it should be a very extraordinary circumstances. And we need to make on the indices again higher low for the bullish scenario, and then resumption of the uptrend, which we have done in 2010, 2011, 2015, 16. There are numerous examples where there was a very, very strong case for the continuation to the downside, and yet it didn't happen. And then for the bearish scenario, again, I'm kind of repeating myself here, break of this low, of this minus sign of weakness low. If we are going to break that, then we're still weak, and that would be suggestive of the follow through to the downside. Bruce, we're at 4:30. Going forward?
Up to you, however you want to do it.
Okay, well, let's go forward. Okay,
Yeah.
Let's talk about this sentiment.
So this chart is just really about investor returns versus investment returns, and just pointing out that when you get into the late part of the cycle, and this is such an interesting chart because, again, I don't want to pick on ARK, but I do think it's a good example, is look at the COVID low. This is assets under management in the purple chart, and it's under eyeballing this, it's under 3 billion. And it gets up to where it's almost 30 billion, call it 28 billion. So let's say that this goes up tenfold in capital responsibility, with an acceleration of that in the last part of the move up. It looks like a hypodermic in terms of how fast the assets under management go up. So it takes a tenfold move in assets going into ARK. Now, some of that's appreciation, but a lot of it's new money being invested, and to create a 386% move in the ARK index. So there's a majority of the money came in from October to February 2020 to 21, and the majority of the money came in, call it from 10 billion to 28 billion, and it only moved the market up. It was the worst part of the performance for that move. And the only point I want to make by that is that history shows that investor returns, when people put their money into the market, when people put their money into individual stocks, and this is what Wyckoff meant when he said, understand the real rules of the game, because this is the opportunity for the large composite operator types to raise cash on the backs of the public. And so this is how they do it. And so the market was going up, which made investors happy, but it was going up at a much slower clip than the rate at which money was going in to the ARK fund. And so, and this ARK is only one example. This is going on across the market. And there are some other charts to illustrate this as we go through. But anyway. This chart is the ARK on the left, and this goes back to 2019, and you can see the COVID low there. And below that is the equity put call ratio. And so across this area, I want to point out, and I'll make this more abundantly clear here in a minute, but you can see the big run up in these super growth names that are in the ARK fund. And look at the sentiment. This purple line shows when there's so much call buying that you're getting into an extreme level of, and this is a 10-day moving average of put call ratio, that you're getting an extreme amount of call buying relative to put buying. And so notice how this 10-day moving average lived down here from 2020 to the end of 2021 in this extreme range, while the ARK fund made a high and then actually sold off from that level, the call buying. Now, all that call buying wasn't in just the ARK stocks, it was in all stocks. But you know that there was a lot of speculation in those super growth names. And so you can see the sentiment, which is call and put activity is largely a speculator area. It's largely the public, and some large institutions will trade these. And but the ARK fund has its initial fall off of a hypodermic top and a break, TP top, and then into a range bound condition, which is a redistribution. Now go over here to the right. This is 15 years of data in the NASDAQ 100 mainly, and we don't have 15 years of data on ARK, but you can see here, this is a 25-day moving average of put call ratio. And the NASDAQ 100, which is mega cap growth stocks, look at the acceleration that came in the final leg up 2020 off the COVID low into what Ramon called a hypodermic or a TP top, and then a very sharp break. Look at the 25-day moving average of puts to calls. Huge call buying, huge extreme bullish sentiment by speculators. Now, I want to point out that when you look at that over a 15-year time frame, look at 2008, 2009. There is a year, more than a year, of extreme put activity into the final lows of the great recessionary decline in the economy. So extreme pessimism into the final lows of the Great Recession, and that kicked off a bull market of epic proportions. And over here we have an extreme secular call buying bulge in 2020, 2021 that coincided with a climactic blow off of the NASDAQ 100. And the only point I want to make looking at those charts is that those are like, you know, they're ringing a bell at the tops and the bottoms of the market in terms of sentiment. And when the extreme speculative sentiment shows up, one way or the other, call buying or put buying, and it occurred. And you can see it was more than a year of that call buying activity into the final hypodermic top of the NASDAQ 100, which leads me to believe, Roman, that we've seen the blow off top in the NASDAQ, and we're going to see rotation into other parts of the market is going to be where the action is going forward. And note here that the rally in the put call ratio towards put buying with this huge decline. Look at the extent of that decline in price in the NASDAQ 100, and we haven't gotten anywhere near the upper extreme, the bearish sentiment extreme that's normally associated with a good intermediate low in the market. We're not even close. And so the sentiment is not there yet on puts to calls. So I'll leave it at that. Ramon, you may have comments. Did we lose you? Oh, Ramon, you might be muted.
Oh, I'm sorry. Oh, yeah, I was muted. Apologies. So I'm really happy that you have
probably the
here.
best thing that you had to say all day. The most important thing you had to say, and you were muted.
I know. I'm really happy that you put in the arc here because it could be the roadmap, to a potential downtrend. Please note that I'm saying potential downtrend. We still have to confirm that, right? So
Yeah.
we still have to have this reaction, maybe a higher low, maybe attempts to go up that will fail. I mean, like US is definitely stronger than other, let's say even countries, and therefore the price structure could be somewhat different, but the structure of how the sentiment is being reflected through the put call ratio could be the same. Last speculative run, first move down. And what happens, prior to that? We have a lot of activity. And remember all of those stories, guys, where a lot of retail people would be engaging in options trading. It was a very speculative environment and so on and so forth in ARK and growth stocks, technology stocks. Then a change of behavior that does not change the behavior of weak hands. And there is still a very strong weak hands call buying. But now they are not making money. Now the CO exhausts their participation in the market. Now all of the money that were made on the way up in those call options are being given back to the CO who's selling into those rallies while weak hands are buying call options. And only when we start going down, that's when we see the increase in puts here. So kind of the same story here, right? So change of behavior, it doesn't necessarily mean that those call option buyers are away. We, as Bruce has said, we need very, very much extreme, put presence in order for us to see some kind of meaningful low. So I thought, Bruce, that was very, very interesting. Okay, another indication of that of the diminished speculation, semiconductors group, and obviously technology stocks are very sensitive to rates, and we're seeing how, especially in the last part of the 10-year yield where there's a lot of acceleration, we're seeing that the semis are actually showing some weakness with the first initial change of behavior, then a potential redistribution to be confirmed or to fail. We have to see whether one or another is going to happen, and then rejection again, and rejection on increased supply signature and acceleration to the downside. And Bruce, you have a PNF count here. This is not that visible, but still, do we have more potential for the downside?
Yeah, so I'll just say this about this chart. Classic Wyckoff horizontal counting methodology, two important reaccumulation type structures, the turquoise and the purple. Notice how they confirm each other at the highs. And then, and this is actually a chart that we've been working with. This is from February 4th. And look at this beautiful classic distribution structure. And there's a beautiful in yellow distribution count. And this count goes down to the low 200. I can't see the exact number.
219, 216.
Okay, and so there's still more to go. That's all, you know, and also it's forming redistribution. So semiconductors as a former speculative favorite are falling out of favor. And that's the reason that I think rotation is such an important part of the markets here.
All right, let's go to the next chart. NASDAQ 100, and Bruce, we're again looking at the put call ratio.
Yeah, so this chart has a couple of attributes. I'll just say this, and you guys can look at it and think about it later on. This is classic Wyckoff trend line analysis. Those two blue boxes there in 2010, 2011 under the demand are the low points that create the demand trend line. Look at how it informed the stride of the market all the way to 2020. So impressive. And one single point up there at the top in between them is where you set your parallel overbought line. And look at how beautiful that is. We threw over the top in 2020, and that throw over of the top of the channel has produced what I call an overbought and a throw over. And it came with the extreme secular sentiment, which we talked about, same data. This is just, this is 10-week moving average, and it just shows how the call buying activity by public speculators, by small speculators has been just extreme as we've had the throw over. And even now we're just not anywhere near the place where we have extreme pessimism and the conditions for a good intermediate low. And even though, you know, I know that we're all relative to the institutions, all of us are small speculators. Compared to that, we need to think like we're professionals. We need to think and act as professionals, irrespective of the amount of money that we have to work with, either as investors or traders. That's what Wyckoffians do. And if we do that and we practice that, we're going to get bigger and bigger and bigger. So think like a pro, think like in the way that a true composite operator would trade this game, greatest game in the world according to Richard D. Wyckoff, and act accordingly. And you will one day become a substantially large investor trader. So just a little editorial comment.
All right. Fear and Greed by CNN. It was very interesting, Bruce, as we were discussing the lowest or one of the lowest numbers. That was on February 24th. That was that spring event. And
yes.
Below that, we have a historical timeline of this index. And then below that, we have today's reading, which is 43, and they put it in the fear, or rather neutral category here. So your quick commentary on this?
Yeah, just that this is just a great kind of, you can do a search on this Fear and Greed Index, CNN Business, and you can see this every day. It even updates in the middle of the day. This middle chart is just a history, and I just would like to just make the point, look at late 2019, 2020 at the start of the year, that almost hit 100. And notice how the extreme of bullish optimism came immediately before the COVID drop, which took us to the zero. I mean, we were trading in the low single digits at that low in the COVID low. which produce one of the great buying opportunities. And so look at how quick you went from extreme greed, using their terminology, to extreme fear. And it's good to look at this from time to time. The put call ratio on the right is just something we've been talking about in the last few slides, so I won't even go there.
Okay. All right. Let's go to some of their, I think that we're going to go until 5. So we have 10 minutes, Bruce. So
Okay.
maybe a minute per slide. I think that we still have 10 plus slides. Let's look at some of the selection: oil, grain, silver, and gold. So oil, we've talked about oil a lot, just because, well, first of all, there is a lot of movement there. There was a lot of movement. There is still a lot of movement in oil. What I would like to point out is the climactic run. It's well defined, well characterized by the increasing volume signature, increasing momentum to the upside, increasing upward spread gaps, and then the stop in action, which we would label a buy and climax, automatic reaction as a change of behavior, which is suggestive that we are just basically in the trading range. And Bruce, when we look at the P&F counts, I think that we came exactly, or if not exactly, we overthrown this count. And how would you explain that overthrow?
Not uncommon. So the point and figure, I love to do point and figure on crude oil. It just historically just seems to work so spot on. It's really quite impressive. So we have a distribution count in yellow. Look at this, goes down from a count line of 65 and a high of 76, counts to $7.60 to minus $3. Crude oil went negative. And so, amazingly, but look at it, went down exactly to the 760 level at a minimum objective on the point and figure. Actually, the intraday did go negative on crude oil, but that count worked out so well, and it came on a big climactic decline in the green box. And look at the count line. So we put this chart up. We looked at this chart here in January of 2021, and we looked at the count line at $35. We actually published the chart when it was 50, called $53, and said that we had a count that went 85 to 112.5. And so lo and behold, this is what happened. You can see there the upward stride of the advance as it worked its way higher, higher highs and higher lows on the vertical chart on the right. There's not uncommon in horizontal counting is that it threw over that 112.5 level for 2 trading days. That's all. It went above that 112.50 level for 2 days. The second day, we call that the buying climax day, had a huge tail in it, and then retreated right away back below that 112 level, and has been range bound ever since. So I think that point figure chart worked fantastically well. And now I believe we are range bound in crude oil for the foreseeable future. And this could be weeks to months, and that we're building new counts for new moves. My suspicion is it's probably higher crude oil in the future, but I'm going to let the charts tell me where crude oil wants to go. So that's pretty much my high points.
All right, we gotta go faster, Bruce. 7 minutes.
Okay, I will.
Okay, let's look at.
I'm so impressed people are staying with us. Well, it's
I
like
know.
we're doing this marathon session. I'm so appreciative that you're sticking with us through the whole
Yeah, we
thing.
appreciate this, guys.
Yeah.
Stick with us a little bit. We're gonna finish at some point. At least we're gonna finish at 5. Okay, so let's look at grains. Food crisis already in some of the countries that are low-income countries, that are third world type of countries, and it just being lost in the news cycle right now, but it's happening, and there is a reason why. Look at all of these charts. What do you see in the latest parts on the right of the charts? They're all going up. They are all showing some strength. And, a lot of them are still suggesting continuation. I would be thinking that, oats, continuation, at least suggesting, canola, continuation. Wheat might be in some kind of trading range. Soybeans might be in some kind of trading range. Rice, either continuation or some kind of trading range. Corn, not a very deep reaction. We just come into the resistance, so maybe a small trading range. The same for soybean, oil, and meals as well. I mean, Bruce, there is so much uh, uh, acceleration in food prices, and we know how food influences the inflation numbers.
Oh
So
yeah.
do
So
you
there's
think that
just
this
total,
might continue?
yeah, there's total momentum not only in these markets, but also in the CPI. Even if the CPI slows from here, and we do have some higher counts in that CPI point figure, even in this lower objective, it's liable to skid a little higher in the CPI. And this is pretty painful to look at because these charts just look fantastic. And I mean, they look really good. And this is why we as investors can't shy away from the market here, because inflation is going to force us to continue to participate, because every year we go without making a return in markets, we're 8% poorer on a purchasing power basis. We have to find a way to be able to invest and cope with the new world order for investing.
And one of the ways for us to trade assets like this, because usually we would go to the futures, right? So if you're a trader, you would be very accustomed to trading futures. But if you're an investor, ETFs related to different, food groups or food assets would be the way to go. All right, let's look at silver. Bruce, this is very interesting. George Lindsay came probably a couple of times already today
So
in
this
the
is just
discussions.
this concept that he developed called Three Peaks in a Domed House. I have a friend, tip of the hat, one of my Wyckoff friends who basically just looks for the structure, and he sent me this, and it's pretty darn interesting. I'm just going to leave this with you. But here, Ed Carlson, who is a fellow APTA member, APTA Society, wrote a really nice book on this. And so you might want to check this out. But this is a classic reaccumulation structure in Wyckoff. This is a rally up, the three peaks, the dip to 10 is like a spring in a test, a rally up to 15, and then a backup. And you can just see that with a throw over, and it just runs up after that. Well, and this is not my interpretation, this is my friend's, and I thank him for this, is that look at the three peaks here, the labeling of the three peaks, and 10 is the low. And this chart here in silver is not regular scaling, it's percent scaling, which we've done some really great work on. And just doing the percent scaling count on that area around that 0.10, which we're seeing maybe near a conclusion, I get a count up to 3164, Ramon. And that takes us up to what I think would amount to 0.15 if we can get a continuation of silver up to 31, which is just over the top of this chart where it is.
Mm-hmm.
So just leave it at that for now, and you might get a kick out of looking at that. And it's pretty interesting, kind of a theory, the three peaks in a domed house. So.
Okay. All right. Gold. So we're gonna go through this really quickly. First of all, why is gold so weak lately? Well, I've talked about this in multiple sessions many times that I don't like this high. I don't like this high because it didn't overcome the all-time high. So to me, it sounds like, some kind of weakness as the price moves up. The second point of weakness, just the change of behavior itself, it's pretty dramatic. Takes us back to the level of the resistance So this was a really good, structural point to stop initially, but then we see more weakness here, where there are multiple attempts to rally and we still cannot produce a really meaningful rally off this low. So I don't see any trading opportunities here necessarily. I don't see any long-term investment opportunities here. And I still think that we're working on this long-term structure. We are probably in some kind of longer term oriented trading range. This doesn't sound really good, right? But we could go down, we could go up, we could stay here for a while, and only after this we could potentially start moving to the upside. But it's very encouraging that Bruce is showing us confirming counts here, Bruce.
And I will only add to that, and this is also from a friend of ours who is a Wyckoffian for many, many years, is that, and he sent this and we thank him for being able to use it, but also going from the right hand backing up action on this very large structure that goes back to 2012. What if there's a count here that goes from the backup all the way across? So that's a
You mean all of this?
yeah.
Ooh.
Yeah, so this might be an intermediate term count in a
I never
bigger
thought about it this way, but very, very provocative. Bruce, I would also be thinking like, if the idea that we still might have some count, and we usually want to see, the counts corresponding. So
Yeah, they're close, but they could get, this could get bigger.
so I'm thinking like we need more columns here just because of this price action. And then maybe the count will come to this point and not to this one right here. So we'll create like more columns here, which will have the same type of count, right? So maybe like -1, 2, 3, 4, 5. So additional 5, 1, 2, 3, 4, 5. And then from here we are counting and it's going to be the same count. So that's kind of like my thinking about gold.
Excellent point. Excellent point.
Okay, let's move. One more thing. Why is gold so weak? And some of the metals, US dollar is in the uptrend. And there is definitely this inverse correlation between the strength of the dollar and the weakness in gold and strength in gold. So we just wanted to bring your attention to this.
I think gold and the dollar are like a flight to quality rally right now. And and look at how the dollar really signaled that in that accumulation structure back there in 2021, 2020, that it wanted to go up. And sure enough, it has, and it's got to count up to 28.
Yeah, which makes a lot of sense because 28 was that COVID upthrust. So to come there and to retest that would make a lot of sense. All right, so yeah, and here is the PNF. I'm sorry, apologies. For the UUP, which is the US dollar index, and we are seeing exactly what Bruce is saying. The target is around 28. All right, let's go to something else. Bruce, do you have another 10 minutes?
Oh, I've got 10 minutes if our people have 10 minutes.
Okay. All right, guys. Well, feel free to go if you need to go, guys, because we are recording this. That's number one. Secondly, we're going to put this on YouTube. We're going to put this on Twitter as well. So you will be able to come back and just, finish this episode.
And anybody who needs to run, thank you so much for being here.
Absolutely. Thank you guys so much. Let's talk about international markets.
And we are almost done, by the way. So
yeah, and talking about, the dollar. You just mentioned that the dollar is the flight to quality right now, and how true. When we look at the international markets, there are some pockets of strength. There is definitely, something like Canada. Look at the index there, and we're showing here, I believe, 1 year actually.
And of course, Canada is a natural resource economy.
Natural resources, materials, yes. Look at the UK, Bruce, in Europe. So UK is
financial economy.
The strongest in Europe, but everything else in Europe,
flight to quality. UK could be flight to quality.
Could a local flight
to safety.
Yeah. So Spain down, France down. China has been in the downtrend for a while. Russia coming to a default. So I don't believe that Russia has any chance, especially if nothing will be done this month. That's almost like equals to an automatic default. And there is no even trade in there. Italy down, Germany down, and Germany is the strongest, the biggest economy in the European Union. And then on the background of this, S&P is somewhat stronger. Canada is definitely strong. And then UK, as we said, kind of like a local flight to safety, is stronger. So Bruce, what else could you say about international markets? Any ideas here on this slide?
Well, it's a rotation theme. It's a relative strength theme. Everything is relative strength. And of course, as somebody had mentioned earlier, what do we do relative strength to all in S&P? It's like, because I think that's the institutional bogey for just about everybody. And so I think that what you can do, and we didn't put that in here, but that's okay, is do relative strength to these markets. And the ones that are showing relative strength leadership are the ones you want to go with. So Canada is definitely doing that. And for the most part, these other markets are not. And so, and also a natural resource economy is Russia, and look at how they've been taken out. Australia is a natural resource economy, so go look at that one. And that's like very, very important. China is somewhat of a high tech market. They're technology producers. So just keeping that in mind also.
All right, let's move on. Okay, I think we're close to the end. Bitcoin. All right. So Bitcoin, as we speak, looks like this. And this is not necessarily a good look for today. All right, so what do we see in today's bar? Supply is coming in, increasing substantially by substantial number, substantial percent over the previous bars that are down. And that comes after two events. First one is an upthrust action. So that's number one, or rather, I'm going to say upthrust, not upthrust action. Secondly, we had an apex formation. And with the apex formation, the whole idea is that we are accelerating out of it. We have very, very shallow reaction just because supply has been observed. And then we have almost immediate continuation to the upside. Instead, we are failing, and we are failing with the increased selling. So therefore, now that we're going to come back to our slides here, I want to show you an example of how out of the reaccumulation pattern, we are breaking out. We are making the false breakout here. This is Russell 2000. And then as we're thinking about the backup action and we come to the support, this is the area where we should continue with the overall bias to the upside, and we don't, and we fail. And this is what I'm expecting, maybe to a certain degree with Bitcoin, to have some kind of bar that's going to accelerate to the downside. But that's going to stop around 40, 39, 38, somewhere in this area where the previous testing has been done. So that's a failure. For this not to fail, we need to come to the support and then start to continue going up, presuming that push to the upside. So I wonder what's going to happen. I have position in Bitcoin. I've had it for quite some time. I've been kind of like in and out a little bit, but majority of my positions were opened in these two spots. I have taken the profit here. This was my trim. I had a stop loss here. So as of today, I'm out 2/3 of my position, and my catastrophic stop loss is just below the area of the testing, of the previous testing. If this level is broken, if we're going to have something like this, there is no reason for me to wait and to see what's going to happen next. Are we going to go below? Most likely. So with that, I think it's all tactical, Bruce. The background is still to the downside, but we had temporary strength here, which we used, to create those positions. But taking profits here, closing some of the portions of the position, I think is very warranted. And then just wait and see what's going to happen. Bruce, your final thoughts on Bitcoin, and I believe we're done.
Just that you and Alessio are so good on crypto and Bitcoin, and I'm a fan. I'm glad I get to watch. I'm glad I get to be a fan. So anyway, that really good stuff.
All right. Well, wow. Ooh, that was epic.
Epic.
Bruce, I don't know how we did this. I think we did this only because majority of people were staying with us, and that gave us some, strength to continue.
Yeah, and thank you so much for attending. And we covered a lot, but we felt like we really needed and wanted to just, put it all out there for you to see. And as we go through the week to week to week, we get a little bit more granular and focus individually on markets, and we do a lot of stock selection and things like that. So keep that in mind. Come join us, become part of our community. I think you're going to find that we're going to add a lot of value to your approach and to your ability to be able to navigate this incredible environment that we're in that is just stunning. I think the Fed is just stunned by this. And, we just got to step up and do our work. And, I'm grateful that I had an opportunity to come into the markets when the last time we were in a raging inflation. So I have a little bit of background there with my business partners that I've worked with for many years, Martin Pring, Joe Turner. And so anyway, we're going to get through this, and we're going to do it. I think Wyckoff is going to be a wonderful way for us to navigate this.
Yeah, I think the key is do exactly what we're doing, to be an observer of the market, and then to create, as we call, scenarios, and see what scenario is going to unfold, and then take opportunity of that scenario unfolding. Bruce, this was an amazing session. Thank you so much for all of your thoughts and contributions. And thank you guys so much for being here. We really, really appreciate all of you and every one of you, members of our communities, our guests. Again, if you would like to become a member, sign up before the next Wednesday, next class, at the promotional rate of $79. And we will be happy to see you there next Wednesday. Bruce, thank you again.
Thank you all. Have a great week, and we'll see you next week.
Bye-bye.